Okay, now we look at the non-registered account. Three main accounts in Canada: the RSP and all its derivative accounts, the tax-free savings, and the non-registered account. The non-registered account is the normal account. The RSP account is designed to incent specific behavior. It's designed to incent Canadians to save for retirement. The tax-free savings account was designed to give a break on some income. I think the motivation, not that I'm a cynic, but I think the motivation was to win the retiree vote, but that's neither here nor there. It's a nice account. The non-registered account is the normal account. All tax rules apply. Okay, so what is a non-registered account? A bank account is a non-registered account. A joint account is non-registered. You can have an investment account that is a non-registered account. A margin account, if you're borrowing to invest, that a margin account is a non-registered account. There's probably a few other examples that I'm forgetting, but that's it. Now, I should point this out. If you go to your bank and say, hey, I want to buy some shares of VTI in my bank account, they will say, no, sorry, you can't do this in a bank account. You have to go talk to an investment advisor. So you can't place the same investments in all accounts. A bank account is simply a bank account. You need to open up a special investment account to be able to place investments in it. Now, I should also say this. We talked about the RSP and derivatives. We talked about the tax-free savings. Now we're talking about the non-registered account. You can place the same investments in every account. By and large, there's probably a few exceptions, but if you want to hold shares of an exchange-traded fund, that can be held in an RSP, in a tax-free savings, and or in a non-registered account. You would have to open up an investment account, but the investment doesn't care what account it's in. Okay, so I talked about that. Now I'll say this. The non-registered account is likely the least attractive place to save money. Why? Everything is potentially taxable. I'm going to get into examples and show the structure in a second. But if you have savings in a non-registered account, and it's not it's not extreme short-term savings, and let's say you have room in your tax-free savings account, there's no good reason that you wouldn't save that in a tax-free savings account. Unless you're saving to buy Christmas gifts to be spent in a month, that's a little bit different. But if it's long-term savings and you have room, at least in a tax-free savings account, there is no good reason that you're saving in a non-registered account. Okay, I'm going to move on and I'm going to remove my face. Okay, the structure of the non-registered account. All activity is potentially taxable. Interest and dividends from non-Canadian companies add to taxable income and therefore your marginal tax rate. So let's go to an example here. Let me flip down to this screen. Let's say I earned $50,000. So I'm in this bracket here. And I'm using Ontario as the example. This works in any province we look at, but the rates might be a little bit different. My marginal tax rate is, I'm going to call that 30%, 29.65. If I get $1,000 of interest income, I have a GIC for instance, it pays me $1,000, I get to keep $700 and the government takes $300. Now, so that's interest and dividends from non-Canadian corporations. If I get a dividend from a Canadian corporation, that is my rate on that dividend. If I get $1,000 of dividend from a Canadian corporation, I pay 7.56%, so I would pay $75.60. Well, look at the difference. That is quite interesting. Now, how this works, I'm going to do a video on this at some point, is you get a dividend. You gross the dividend up by 38%. I don't expect anybody to understand this. I'll do a full video on this. That gets added to your taxable income. So you might be saying, well, that sounds horrible. Your taxable income has risen by more than the actual dividend. That's right. Then at the end, you get a tax credit that knocks the tax paid on that dividend down to 7.56%. The problem with this is that there's a lot of means-tested programs out there and means-tested credits. I'm thinking of the age credit and the OAS clawback, for example. They base their clawback on taxable income. So it's you can see what the problem is a little bit with that gross up and then the dividend. So I will do a video on that in the future. However, this is the rate you pay on the dividend. So I would pay $75.60 on $1,000 worth of dividend from a Canadian corporation. This is if you own your own small business, so don't worry about this. And this is capital gains. Note that the capital gains rate is 1/2 the marginal tax rate. So how a capital gains works is, let's say I buy a vintage car for $10,000. I fix it up and I sell it for $50,000. I have a capital gain of $40,000. 50 is the selling price, 10,000 is what it cost me, so I have a $40,000 capital gain. The taxable capital gain is 1/2 the capital gain. So in this example, I got a $40,000 capital gain, I would have a $20,000 taxable capital gain, and my income would be boosted then by $20,000, the taxable capital gain. So that is a bit of a tax break. And the nice thing about capital gains is you get to decide when you trigger the tax bill, because nothing happens until you sell the investment. That's when the capital gain gets triggered, and then you have to bring the taxable capital gain into income. So, that's it. Okay, so we talked about interest and dividends from non-Canadian corporations. We've talked about dividends from Canadian corporations, and we talked about capital gains. Okay, so I want to talk about capital gains a bit. They do receive preferential tax treatment. So there's two things with a capital gain. There's the capital gain and the taxable capital gain. If I have, let's say, a $100,000 capital gain, that boosts my taxable income by $50,000. The only exception to capital gains is the principal residence. If I buy a house for $100,000 and 40 years later it's worth $1 million, I sell it, I've got a $900,000 supposedly a capital gain, but I don't have to claim any of that because there is an exemption for principal residences. If you buy a second home, that second home does not have the exemption. So you have to watch out for that. A lot of people buy second homes, fix it up and rent it out and then sell it, and they get they especially lately in a booming housing market, they get hit pretty hard with the capital gain tax. Now, this gets interesting. It can get, let's say you're lucky. You have that magical investment. You put $1,000 in and it grows to 10 million. And let's say you have that in a non-registered account. Well, you're very happy. You've got an account that has a $10 million value on it, except not all of that is yours. Some of that is the government's. And in this case, you've got a $9,999,000 capital gain, so half of that would be taxable. So you would have a huge tax bill if you sold it. Nortel employees back in probably the early 2000s or the late 1990s, they were employees. They were investing in their company's shares. Some of those shares were invested in a non-registered account, and the shares went through the roof. So, I imagine the typical employee said, I wouldn't mind selling some of this. Then they investigated, and they realized that if they sold it, they would have a big tax bill. Well, I think that may have entered into the equation of, well, maybe I won't sell it. Maybe they put it off. Maybe they said, yeah, I'd like to sell it, but I just realized that generates a massive tax bill. You know what, I'm going to look at this some other time. Then Nortel went bankrupt, and those shares were worth nothing. So having a large unrealized capital gain in a non-registered account can become problematic. and it might affect investment decisions. So keep that in mind. And I'm not suggesting that selling it or not selling it is better, but you can see how the reluctance to sell it grows as the capital gain grows, just because the tax bill grows as well. Okay, I'm going to leave it there. Thank you for watching. Keep on fighting.